Hello YouTube. Today I want to talk about timing the market. So many people, it seems in this day and age during the pandemic, are becoming day traders, and I find that really interesting. When the market is booming and we have stocks like Apple and Microsoft and a lot of the tech stocks, Amazon, Tesla, booming like crazy, it's quite easy to jump on the bandwagon and make money. But generally, in the long run, the best way to make money in the markets is to invest in a great stock, whether it be a dividend stock or a stock like Apple, in the Canadian markets, Shopify. These stocks have proven over time that if you just buy them and leave them alone, they will make you a lot of money. And the great thing about dividend stocks is that they will make you money without having to do absolutely nothing. You just set up your stocks in your trading account to do dividend reinvestment, which they call DRIP, and it just does it all on its own. It makes the compounding effect of your investments sort of go on steroids, because each month that you receive new shares through the DRIP program, the next month you make more money because you're making money on the extra shares that you just were given on dividends. So let's look at Apple as an example. In 2010, if you would have invested $1,000 and then reinvested $50 a month until 2020, you would make and have in your account $50,000 from Apple. And that would be dividends and the appreciation of the stock. Let's look at our next example, Amazon. If you would have invested $1,000 in Amazon in 2010 and then additionally invested $50 a month, in 2020 you'd have $72,000 in your account, and that's an annual return of about 38.8%. Now, some folks, like retired people like myself, who like to have their money in what would be more predictable stocks, like Royal Bank of Canada is a good example. I have a ETF that I invest in called FIE.TO, and it is an ETF that is weighted in Canadian banks and financials. And if you would have, for example, invested in Royal Bank of Canada in 2010, you would now, and $50 a month from there on in, you would now have about $10,000, which is about a 7% return, which isn't anywhere near what you get or would have got in an Amazon or an Apple. But for a retired person, 7% return is more than what's needed to fund your retirement. Now, we've talked about a few different stocks and the advantages of holding them long term. Now, one other bit that you need to understand about the markets is stocks go up and stocks go down. And that's where the patience comes in. And as old Warren Buffett would say, who was one of the greatest investors ever, the patient get rich and the impatient get poor. And all I can say about that is that even stocks like Apple, over the last few years, have gone up and down quite violently. So you need to be able to understand that and just sit tight and make sure that you do your due diligence when you buy a stock, and understand that there's going to be fluctuations in the price. It is going to go up and down. It can go up and down 10, 20, 30%. But in the long term, all stocks usually have proven that in the long term they pay off quite handsomely. So I hope you've enjoyed this video and have learned a few things. And if you have some more to add as far as knowledge, I would greatly appreciate it in the comments. And please subscribe to my channel and like my video. I'd appreciate it. Thanks, and have a great day.